Thanks, George. I'm just going to briefly introduce the next two panelists. I've got Ron Bidulka from PwC and Craig Smith from Ashlar Urban. And Ron has been in the consulting advisory capacity in real estate in Toronto and arguably Ontario and Canada for quite some time, and is a former colleague of mine from Deloitte. Craig Smith is one of the many Knowlton Realty alumni, myself included, that got into this wonderful commercial real estate industry years ago. He is the principal and broker of record with Ashlar Urban here in Toronto, which specializes in investment sales and office leasing activity. And I'm going to start right with you, Craig. I know he's dying to get out some hot stuff here. I just want to talk to you relative to everything that George has said. I want you to comment on, based upon what you see in the market, what is good about what's happening in Toronto in terms of investor activity, whether it's for condo lands, and what would you reflect is maybe not so good or bad, maybe perhaps relative to public policy and how that's impacting investment activity?
Yeah, is this working? Okay, it's a bit of a loaded question. Our practice is predominantly right now land sales on the investment side. We do a lot of asset investments. In fact, we're selling George's building right now. But on the land side, I would say, to George's point on the condo market, you know, there's some misnomers about the facts. And George and I talked about this a little bit earlier, which is there's sort of a left and right side of the brain type of equation, and there's a sentiment. And you have a lot of speculative buyers in the marketplace right now. The developers are building high-rise condo in downtown Toronto because it's economic. It's cheap to do. You can pre-sell it. And while I was here, I got 2 emails from guys who are now selling the financing opportunities on the completion of the acquisition as investment vehicles. So if everybody follows that, you've got no security on the actual assets. You're buying a pro forma model, and they're trying to sell that as a yield to investors. So there are some very exciting things going on in the marketplace. That said, the reality of it is it's a necessary evil in downtown Toronto. Condo is not going to go away. The quality of condominium, and I think the various asset classes within that sector are going to be modified in that, you know, we are seeing people putting out 585-foot 2-bedroom condominiums. Now, I know most of the people here probably call that their living room. But, you know, people are on the development side trying to enhance their returns by providing inventory and rental stock. Another shortcoming of the sector, back to the speculative nature of, I think, the condominium end user, the purchaser, is that these people are relying on rental. And George did a very, very good analysis of what is realistically attainable in the rental market. But if there is a blip going forward, and the gentleman on either side of me, one's employed and one doesn't, have identical units, and George bought his all cash, and, you know, apartment B or condominium B has it financed, he's renting for $2,500 a month. Apartment B's renting for $2,500 but can't fill it. He drops that to $2,000 or $1,500. You know what we call that? Market. So you can quickly be impacted by cash flows in the marketplace. As for public policy and what's going on, I mean, we're seeing increased migration downtown because, you know, the infrastructure and sprawl aren't here. And certainly the opportunities that it's creating for the retailers, and George has been involved in a couple efforts on our part, is that it's an effective way to get distribution downtown to a lot of people in a very small mass. Easy answer, right? There's 1.7 million square feet of new retail development between, I guess, really King and University and Bathurst and King. I mean, that's square one. Now, for those retailers out there, you know, it's difficult to get a hold of that, but that is a big risk sector within the condominium sector for the developer. And they're very nervous about it and quite anxious, and they're looking to try and find a way either to get out of it and pre-sell it altogether, or they're holding back the inventory, as some of the larger developers are, because they're actually recognizing the upside by those in the marketplace here who they're realizing won't pay the $25 a foot they pro forma, but will pay 50 or 60. And in the condominium sector downtown, we're seeing those kinds of economic rents, particularly from the banks initially, $50, $60 net in downtown Toronto. The tangible change, and I'll shut up in a second, is taxation still seems to be a bit of a moving target, and how these things are going to be assessed, because they're condominium stock, and with the infrastructure being put in place, you've got strata uses all up and down these new towers. I don't know if I answered the question.
Thanks, George. I'm going to go to you, and you talk about capital appreciation from 07 to 11 of upwards of 40%, and that's a really attractive number for a lot of reasons, alternative investment vehicles being one of them. And then I compare that to the graph that you had that talked about the housing mix and potential shift in 905. So we've seen the single-family detached trending down and the high-rise condo trending up in terms of the stock and the inventory. Where else in the GTA are there appreciation opportunities, if they exist, for that condominium market? And are we going to see similar or even half of that 40% appreciation in the 905?
Well, I think I think this is like that little text on the bottom of your car mirror. It says, no, that's not the text. Past returns may not be necessarily what you're going to see going forward. So I think the challenge is many people who go into these things today have had really good experiences. So if you've had that experience because you bought in 2007, you're more apt to expect the same outcome going forward. I think what is not unlikely, if you think about a couple of the situations of undersupply, if you start to undersupply a region with something as fundamental as housing, that's going to move that price up. So even, in Craig's example, where if whoever's got an income and they've got the unit as their investment, with 0.4% vacancy and likely an undersupply, we'll probably see housing in Toronto continue to be buoyed upwards because of fundamental demand. So I think that might happen. I think that might be unhealthy. And I think the consequence of that, to sort of wade into the question you had for Craig, is policy outcomes. And I think that we're maybe months away, days away, hours away from some major policy statements that might affect Canada. And they're very blunt instruments when you come to policy at that level around housing. They can be very dangerous and have negative outcomes. And I also think, the report that Don Drummond released yesterday, which I don't think he quite called it, but the Greece of the Great Lakes, being the province of Ontario, we're going to have some significant issues around infrastructure funding in some of the 905 areas. So intensification will have to happen in those areas. So I think the trends that you maybe have seen in the 416, it's not a question of if, it's when you'll see those expand into, when, i.e. the next 10 odd years, into the various areas in the 905.
Follow-up question from the audience. Person is anonymous. I think it's Gagne. Do we anticipate, George, do you anticipate, and Ron, I'll even toss this to you if you want to take a stab at it, that the sort of weak economy and or slow rebound relative to U.S. growth and how we ebb and flow with the U.S. is going to have an impact on migration to or in-migration in the City of Toronto or Ontario?
I think from an economy perspective, we've probably seen it, where you see like Alberta's driving growth. But that said, Toronto is still kind of one of the premier destinations that's going to drive population growth. It's going to drive household formation. It's going to drive demand for units. There's still, the one thing I take from George's presentation is that there is a lack of land. And one of the reasons why prices keep going up is because there's no more land. So God's not creating anymore. So the infill opportunities are where you have to go, which is why I think you see inventory dropping in the 905, particularly on the low rise. And then you see the high rise stuff going up.
Yes, I would agree that the two big bets that we've got are that 100,000 people a year, we grow by 100,000 people a year, most of that supported by immigration, and that the grow up, not out planning approach maintains itself. So if you add, if we have 100,000 people more a year that we have to house someplace and it's grow up, not out, then that condo component will have to continue. The question is, will we continue to get that kind of growth? And I think in a world that's 7 billion people, and arguably lots of that is starting to look pretty shaky, little old Canada, which has less snow than it used to have, is starting to look a lot better and a lot safer. And I think it's a destination for people. I think it's also a destination for their capital.
Ron, you're involved in Union Station redevelopment and spend a lot of your practice and professional time in the infrastructure space, public-private partnerships, et cetera. Based upon what you've heard from George and the pressure we've seen on land, and the fact that we all drove here and parked our cars today, are we going to be able to keep up from an infrastructure perspective relative to, you know, the Drummond report from yesterday, what we're expecting in the federal budget, and obviously the pressures at City Hall? And or does that create any risk to some of the nice colors and graphs that George showed?
I think it actually creates great risk. You've got City of Toronto that's pushing up against its debt ceiling, how much money it can actually go out and actually take on. It's got, you know, in some cases, billions of dollars that it needs to do. Transit is an issue in this city, and it's not just along Eglinton and other places. It's down on the waterfront. There's 600 acres, you know, half a click away from here that people want to develop, but it needs $1 billion of servicing, it needs site remediation, and it needs transit. No one's going to invest in there. No developer is going to put their money in there to do that. We've been talking to people like major global retailers, for example, that want to come in here and do, you know, I forget what they call it, but it's globally significant destination retail. They want to come into Toronto. They'll only do it if they can be guaranteed the transit access works. How does Toronto finance that? How does somebody finance that? And then if you go out, as George said, 5 or 10 years, I think you're going to see, you know, Peel, Halton, York Region, all coming in with those same issues. You know, we've got a lot of clients, and I work on a lot of public clients who've got land holdings that are looking at that, and we did a deal about 6 months ago where we modeled the numbers and said, well, we think if you did this deal, you know, you'll get $60 a foot on the land, and they got 80. So, like, people want to invest. They've got significant land holdings. The question is, as you kind of look more broadly on the infrastructure side, servicing, where does the money come from? We need to upgrade our sewers. We need to upgrade the pumping stations. We need to put brand new pipes up to allow for more land to come in. It's going to be significant.
We're going to open it up to the floor if there are any questions. If you want to raise your hand or come to the mic to our panel of astute experts here. Louis?
I'll go. When I started real estate back in the day, we were selling, I used to sell houses, and I had a neat little book that had the interest rates, which helped me calculate the payments, and it stopped at 8%. And I look at things now, and it all kind of ties together with the retail environment. Somebody has to pay for this, and Raymond's graph had the income graph was not keeping pace with anything else. Who's going to pay the fiddler? Where does the consumer confidence, the buying confidence, and at some point in time, if we have just a little bit of a creep in interest rates, that affects everybody. It affects the buying public for housing, be it single family or detached or condo, and then it starts to kick into investment properties because people are going to want greater yield at some point in time. So, and it's just a general question: what's going to happen at some point? Has anybody got a crystal ball?
Craig, go ahead.
I don't have a crystal ball, but what I can tell you is on the investment side, from the clients that we speak to, most clients, particularly those who may be buying a lot of the retailers' assets here, are terrified about the monopoly money they're going to have in 20 years. So when you're looking at flatlined long-term leases, the investors really aren't there for them anymore, because on your question about a 6 cap going on into perpetuity for 20 years with, let's call it a 5% bump every 5, they have no interest in that. They want to find investment vehicles and opportunities that allow them to constantly reset. Right now we're very active in multi-res and student residences because you can reset them 30% a year, right? So you keep up with inflation. I think that, you know, going forward, this is all about rates. I mean, we can take this whole discussion and dilute it down to interest rates because that's what's driving the market right now. and it's still hugely accretive. You're buying 5% and 6% yields with 3.5% money. I just, again, sitting here, got a mortgage commitment today from the BDC for a user on a single-purpose building. It's 5.25% less 150 basis points. Why wouldn't you buy? Why would you ever lease again? Right? They've just bought their facility for 3.5%. So I think going forward, you know, we've got to anticipate that there's a bump past 2013 when the U.S. has basically stated they're going to hold rates flat. And if you're not anticipating that, you're not playing in the right game.
Because on the flip side, or not the flip side, but as a continuation, there's REITs and other owner-operators have a certain commitment. But then when you look at the investment funds or the retirement funds, at some point in time, the people who are retiring will want their money back.
Well, you just hit my favorite point, which is there's no competing with people who use other people's money and don't pay tax. So unless the pension funds are going to go and own everything, something's got to change. Because right now they're stacked, it's all stacked in their favor. Now the REITs, this is probably why Bob's got me here, because I'll tell you what I think. They're overinflated. You know, there's no analyst is out there calling a spade and telling you that if anybody saw the TransGlobe episode on CBC, their product is crap. And they put it into a REIT because you can't refinance 95% levered assets. So the only place to get the money was to go to the stupid money, which was the public markets. And, you know, unfortunately, that's the unpopular thing to say, but it is reality today in that there's a lot of product that is trading for yield basis because the rates are so low that shouldn't be trading anywhere near it. It's not commensurate with the risk.
So we're going to draw to a close. I wanted to thank these three panelists for their effort and attention and answers, and they will be around afterwards for the reception if you want to approach them on an individual basis and get some more color for commentary. So thank you.